let's transition over to, you mentioned ServiceMac, and let's transition to your take on servicing. So we know that in 2019, that was a great year for originators, right? But it was a challenging year for service companies, specifically their retention of customers, right? Prepayments have been up since the beginning of 2019 because of this low rate environment. And according to this recent mortgage monitor from Black Knight, 3 out of 4 refi borrowers were lost by servicers. And this is like these in the money borrowers that have historically been easier to retain. And that's caused servicers to truly dive deep into borrower data. And now we're seeing this shift in the wholesale market, this trend towards referring borrowers back to broker originators due to some type of trigger event, whether that's mortgage inquiry or house just listed for sale or refinance or payoff request. And most of the top wholesalers out there have some version of a Reconnect program. And the servicing side of our business is a pretty interesting one right now. And I think it'd be a good to get your viewpoint, not on those specifics about referring customers back, but just on that side of the business in general. So would you give us kind of a high level view of the servicing and sub-servicing, and what information do you think would be helpful to share with the group?
Okay, yeah, the servicing, sub-servicing sandbox is a kind of a quiet sandbox, and it's been pushed to the forefront over the last couple of years. To a couple of things, just a table set. Going back to the previous criteria, the reason that I got involved in the sub-servicing space is, let me back up for a second. There's servicers and there's sub-servicers. So just a brief distinction between the two. A sub-servicer, which is what ServiceMac is that I'm involved in, is a company that will service someone else's MSR for a fee. So as a sub-servicer, you don't have ownership in the MSR and the risk associated with that, or the reward associated with owning it. You simply are fee for service. And a servicer, in simple terms, is an entity that owns the MSR that also services the MSR, or is in charge of servicing that. So an example of a servicer is Wells Fargo, as probably the largest servicer in the country at 9 to 10 million strong. And then you have non-bank servicers, which is non-banks, originators who actually own their own servicing units. Quicken Loans is a shining example of that, as well as Mr. Cooper. So I just wanted to level set with that. So if you look at the reason is the shift that's going on with the servicing business, I think it's important to know this, it's been a sleepy category for a while, but now it's growing. And there's two reasons that it's growing, two primary reasons. One is banks originating mortgages. Their desire to originate mortgages has decreased over the last 5 years. It's less attractive for banks to originate mortgages. They don't compete as well on their balance sheets. And so most banks have settled into mortgages as an accommodation for their clients. And so within their footprint, this has shifted the origination away to non-banks. And this has created an opportunity. This has helped fuel the growth of non-banks. And you can look at your top 5 retail lenders, particularly look at your top 5 wholesale lenders. And at the heart of this, you've got banks that are not going after this business as much as they normally would. Well, how does that impact the subservicing business? Well, banks, when they make their own mortgages, they typically service them. And and those that aren't made there by non-banks, they typically sell them off to MSR aggregators. So that business, with the banks decreasing and the non-banks increasing, that's had an impact on the need for subservicing. The other reason for my interest in getting into the subservicing business is that the aggregators that are now buying MSRs, they're becoming more sophisticated. There's fewer of them, but they're becoming more sophisticated and they're becoming bigger. So their need to have more sophistication with subservicing and their need to have more retention capabilities, their need to control that valuable product and their sophistication has gone up. We were told by the agency that there hadn't been a startup subservicing company in 10 years. So what that also implies is the technology that the new aggregators or the aggregators, the bigger ones, are requiring more sophistication and have a need for the newest and greatest technology to manage that. I need to manage the cash flows and I need to have more insight to their investment. So number one, it's just good to know what's driving the shift in that sandbox. So now the question is, how does this impact originators? Well, if you look at what a subservicing company does, we all share the same customer at different points of the life cycle. But a subservicing or a servicing company, they both have the same job, and the same job is to maintain the value of the MSR. And there's two ways to maintain the value of an MSR. It's extend the life of the MSR, and it is to provide quality customer service to do everything you can to make sure that the MSR performs. Now, the reason for that, the longer the MSR stays on the books, the more valuable it is to the MSR holder. I think probably most people understand that, which is also why if portfolio is being churned or one is refinanced, it's the minute that it's refinanced, clearly something that an MSR holder bought is no longer valued, it goes away. As it relates to the performance of the loan, a servicer or subservicer is challenged with educating the customer, staying in touch with the customer to make sure that they perform as well as possible, because if the customer is not paying their mortgage, then the MSR holder does not get paid. So the ability to make it perform at the highest level is important. So maintaining the value through those two things is a critical point. Now, having said all that, there's no secret here, but as the sub-servicers and servicers get more sophisticated, they're being challenged to become better at retention. And in the last couple of years with the payoff speeds, typical sub-servicer or servicer wasn't typically staffed for the avalanche of payoffs. So, and that's all, then all that gets reflected in the price of the MSR. So, it's a zero-sum game with the MSRs. So it's important to know that originators and MSR holders, they share that boundary. It's a tug of war, but it's a zero-sum game. So the sub-servicers are now being challenged to meet that demand and be more sophisticated in accommodating what the MSR owner wants us to do, or wants the sub-servicer to do. Here's three examples. And these are three different clients' needs that we have at ServiceMac. A top 10 lender is a client, and they want our company to allow them to answer the phones so they can stay in touch with the owners, so they can stay in touch with the customers of the MSRs that they own. So we have to, through component technology, we're able to allow them to answer the phones in a private label arrangement so that they give that customer one more reason. All the customer service questions they answer gives them one more reason and opportunity to retain that loan or refinance that loan when that customer needs it. We have a second customer is a large aggregator with no retention capabilities. So they rely upon us 100% to stay on top of the book. And their expectations are, in this particular market, a minimum retention rate would be 30%. John, you asked earlier, what's a respectable retention rate? And it varies market to market. In this particular market, because a lot of the retention is refinances, a decent Mendoza line is 30%. Now you have some companies out there that that's just a good Mendoza line. There are companies out there, that are pushing 40 that are better, and there's companies out there that are below 20, and they're not as good as they should be. So I would say 30% is a good level in this particular market. When the market shifts, and a lot of that's because it's refinances. When the market shifts and there's less rates go up, and the shift goes between refinances, flip-flops between refinances and purchase, the retention rates will probably go down, because it's harder to retain a purchase because you don't have the same lead time, you don't have the same opportunities. You got to be somewhat preemptive to retain a purchased loan opportunity, and there's more people involved to pull that loan away from you. So that's the second example. Third example is we have an aggregator who buys MSRs that has their own refinance retention unit. And so the way we work with them is that we obviously have some of our obvious triggers when people pull rates, when tax amounts, when escrow tax amounts change, when a rate changes, anything that impacts the payment of that MSR is a natural trigger. But anytime we know that someone is thinking about it, or we preemptively have information that makes us think that, then we will feed that information. We'll work with the aggregator within their unit to allow them to do that. So three different examples there of how a sub-servicer works with MSR owners to make that happen. So the bottom line of all that people on this phone just need to be aware of is that sub-servicers and servicers are, competition. They're originators at a certain level. And so it's really, really, really important to do things as an originator. It's really important to make a lasting imprint on your originating customer before you sell that MSR, so that when it's time for them to refinance or to do something, that they're still thinking about you. And just know that servicing companies and sub-servicing companies are doing everything they can to make them think about the sub-servicing company and the servicing company. So just some awareness that it's flat out competition.
Absolutely.
So that's probably a good segue into what you can do for that customer that makes them think about you more. And it's probably a pretty good segue into the second mortgage product.